Two people can make the exact same amount of money in a year. One pays a painful amount of tax, the other barely feels it. Same country, same laws, same tax code. So what's the difference? Intelligence? Luck? Connections? No. The difference is structure. Today we're exposing how rich people legally avoid taxes while regular people accidentally overpay. No crimes, no offshore movie villains, just legal strategies hiding in plain sight. And yes, this might sting a little. Let's begin. 1. They don't earn salaries. They own assets. Regular people love salaries. Wake up, work hard, get paid, get taxed immediately. The government says thank you before you even see the money. Rich people, they hate salaries. Why? Because salary is the most heavily taxed form of income on earth. In many countries, up to 30 to 50% is gone before the money even hits your account. Regular people ask, how much do I earn? Rich people ask, what do I own? Stocks, businesses, real estate. Employees get taxed first, then spend. Owners spend first, then get taxed later, or sometimes not at all. So while regular people celebrate a pay raise and lose half of it to taxes, rich people quietly let their assets do the work and smile politely. 2. They use companies as tax shields. Here's a fun comparison. Regular people get taxed, then they spend what's left. Rich people spend first, then get taxed on what remains. Big difference. How? Companies. When regular people buy a laptop, it's a personal expense. When rich people buy a laptop, it's a business expense. When regular people travel, it's a vacation. When rich people travel, it's a conference. Office rent, internet, cars, phones, consultants. Regular people pay for these with after-tax money. Business owners deduct them before tax. Same expenses, different tax result. This is not cheating. This is the rule book. What looks like luxury to you is often labeled operating expenses to them. Instead of paying tax on 100% of income, they pay tax on what's left after expenses. Employees get taxed on gross income. Owners get taxed on net income. That difference is everything. 3. Regular people sell, rich people borrow. This one hurts a little. Regular people need money. They sell something. Stocks, crypto, property, boom, tax bill triggered. Rich people need money. They borrow against stocks, against businesses, against real estate. Loans are not income, so they are not taxed. So while regular people cash out and get taxed, rich people take loans, keep their assets, and let those assets continue growing. And yes, the interest is often deductible, totally legal, totally unfair feeling, totally allowed. When rich people need cash, they don't sell assets. They borrow against them. Let's say someone owns shares worth $50 million. If they sell, they trigger capital gains tax. Instead, they take a loan using those shares as collateral. Loans are not income, so they are not taxed. They get spending money without selling anything. Their assets keep growing, and the interest is often tax deductible. This is how billionaires buy mansions without earning income. 4. They master real estate write-offs. Real estate is one of the biggest tax loopholes legally available. Regular people see a house, rich people see a tax shelter. Real estate allows deductions for maintenance, insurance, interest, management fees. But the real magic word is depreciation. On paper, the government lets property owners pretend the building is losing value every year. In real life, the property is going up in value. So on paper, the rich person looks broke. In reality, they're collecting rent. Regular people see profit. The tax system sees a loss. Congratulations. You just legally paid less tax. Even if a property is increasing in value, the tax system allows owners to claim it is wearing out every year. So on paper, the property shows a loss. In reality, it is making money. Many wealthy landlords pay little to no tax while collecting rent every month. Perfectly legal. 5. Fast money thinkers versus slow money thinkers. Regular people love quick wins. Flip this, trade that, cash out now. Then come the taxes. Rich people play the long game. They hold assets. They wait. They let gains qualify for lower tax rates. They understand that patience is not just an investment strategy, it's a tax strategy. While regular people rush to cash out and celebrate, rich people wait quietly and keep more of the money. Not all investments are taxed the same. Rich people intentionally choose assets with tax advantages. Examples include index funds with low turnover long-term stock holdings, government bonds, retirement, and tax-deferred accounts. They don't chase quick flips. They hold assets long enough to qualify for lower tax rates. Patience becomes a tax strategy. 6. One country thinking versus global thinking. Regular people earn money in one country and pay whatever tax comes with it. Rich people think globally. They structure companies across different regions. They use legal incentives. They take advantage of tax treaties. Nothing is hidden. Everything is declared. But the system rewards people who understand geography. Same income, different structure, different tax outcome. Wealthy individuals often structure businesses across multiple countries. Why? Because tax laws differ. Some countries offer lower corporate tax rates, tax holidays, startup incentives, territorial tax systems. The money is not hidden, it is structured. As long as income is declared properly and laws are followed, this is legal tax planning, not evasion. 7. They pay experts, so they pay less tax. Regular people do taxes once a year, usually late, usually confused. Rich people plan taxes all year. That mindset alone saves millions. They hire tax attorneys, accountants, wealth planners. They don't ask, how much tax do I owe? They ask, how do I legally owe less next year? And here's the irony. The more money you have, the easier it becomes to pay less tax. The system is not broken. Here's the uncomfortable truth. The tax system is not broken. It's just written by people who understand money. Rich people don't avoid taxes illegally. They avoid them intentionally. They own instead of earn. They structure instead of guess. They plan instead of react. Meanwhile, regular people play the game without reading the rules. And that is why two people can earn the same money and live in completely different tax realities. The tax code is a rule book. Most people never read it. The wealthy treat it like a playbook. And once you understand that, everything starts to make sense. If you enjoyed this breakdown, subscribe. Because next, we're talking about how the middle class ends up paying the most tax of all. And trust me, that one is even saltier.